The Dutch National Bank, who I've talked a lot about, and the revaluation accountant, he recently said this has been a political decision. If there is a financial crisis, the gold price will skyrocket, and official gold reserves can be used to underpin a new gold standard, according to the Dutch National Bank. Our gold reserves are a matter of financial security and stability. Gold will retain its value even when someone cuts off the power to the global financial system, destroying traditional assets based on electronic accounting records. Of course, we do not assume that this will happen, but the saying goes, forewarned is always insured, and the central bank is required to be prepared for even the most unfavorable circumstances. That is why we see a special place for gold in our foreign exchange management process.
Gold hit an intraday high of $2,522.50 on August 2nd. Driven by a disappointing U.S. labor report and ongoing geopolitical problems. The Dutch National Bank highlights gold's crucial role in financial stability, noting that in a crisis, gold prices could soar, and reserves might back a new gold standard. They view gold as a dependable asset, maintaining value even if the global financial system collapses, underscoring its importance in their strategy. As of July 2024, inflation has shown signs of the Consumer Price Index, CPI, increasing by 2.9% annually, its lowest rate since early 2021. Andy Schectman, the president and CEO of Miles Franklin, recognized for his expertise in gold and silver markets, discusses that in an inflationary environment, the wealthy benefit as their assets appreciate, despite a loss in purchasing power. This drives them to favor inflation, as asset values rise. There is skepticism about the transparency and effectiveness of financial authorities, exemplified by the Federal Reserve's actions prior to the Silicon Valley Bank collapse. The Federal Reserve has signaled that its aggressive rate hike cycle, which has brought rates to a 23-year high of 5.25% to 5.50%. The Fed's rate hikes, despite significant unrealized losses in the banking sector, led to market instability. Fed may reduce rates by at least 75 basis points next year, aiming for a soft landing without triggering a recession. Andy Schectman, in an interview with Dunnigan Kaiser, calls for rate cuts, despite potential risks, reflect ongoing tensions around managing inflation, currency strength, and economic stability. These are directly linked with the price of gold. Critics warn that pursuing lower interest rates and a weaker dollar could exacerbate inflation and increase debt challenges, with some suggesting alternatives like issuing gold-backed long-term treasuries. In 2019, efforts to normalize balance sheets caused market disruptions, like the repo market blow-up. Similar attempts in the UK and Japan led to financial instability. These issues stem from years of low global interest rates, creating excessive debt. Now the system faces a choice: endure inflation or risk collapse due to gold, exposing its fragility. Before we dive into Andy's discussion, make sure to subscribe and hit the notification bell so you don't miss out on more content like this. Thanks for watching, and enjoy the video.
It's the wealthy who do well in an inflationary environment because their assets go up in value. And so you see even the hint of deflation and the assets start to crumble. And so that's why they always choose inflation, because the wealthy get wealthier. Not that they're losing purchasing power, but their assets go higher. But it's true. And then you talk about, being lied to real quick. You have right before Silicon Valley Bank failed, you had, the Fed, Powell in front of Congress saying, that, nothing about the data suggests we've tightened too much, right? And then 2 days later, Silicon Valley Bank fails. And you go back and you go all the way back to Bernanke saying the subprime crisis is contained, and boom, it blows up. And the way they said there is no inflation, okay, it's transitory, okay, fine, it's structural, okay, it's going away, but the numbers are all a bunch of lies. And when you talk about Silicon Valley Bank, the FDIC reported $600 billion in unrealized losses in the whole banking system, and the Fed always claims to be looking at all of the data, and they're supposed to be the key supervisors of the banking system. They would have had Silicon Valley's books. They would have had it all, and they didn't. And they jack up rates, and the whole system collapses. And here again, after you see one-day drop, you have Jeremy Siegel, trotted out almost in tears, begging for a 150-point basis rate cut. Here again, to go, not only would that be the worst thing to do, because it would only exacerbate the unwinding of the carry trade, because it's if the yen goes higher, or the interest rate goes higher, or the interest rate received from U.S. Treasuries goes lower, Well, the yen carry trade unwinds further. And I mean, they're not thinking this out. But here again, giving in to austerity, giving in to lowering rates in a weak dollar, and those aren't good things. And it's what they have always chosen, and this is what Trump wants to do too, and which kind of bothers me. He's advocating for a weaker dollar and for lower interest rates, and Vance is talking about, well, maybe the dollar shouldn't be the world reserve currency. Where'd we hear that before? Oh yeah, knucklehead Jared Bernstein. So I don't know that anyone's going to be able to pull us out of this, but what I do think is that we are destined for much higher inflation as a result of a lower dollar, a lower interest rates. But what does that do to the debt? Who wants to buy our debt? And maybe this is why you see Judy Shelton come up and say, yeah, well, that's why you should issue 30-year treasuries in gold. They tried to normalize, well, it started with us in 2019. We tried to normalize the balance sheet, and you get the reverse repo, or you get the repo market blow up and everything goes upside down, they pivot. And then you get the UK, they try to austerity and normalize their balance sheet, and their pensions almost blow up, they pivot. And then you get us raise rates to 5%, and the banks start blowing up, and now we're talking about pivoting. And you get the Japanese who do this and raise rates just a little bit, and strengthen the yen just a little bit, and everything blows up and they pivot. This is a situation that has been created by messing with Mother Nature, by suppressing interest rates globally for so long, creating and incentivizing so much debt that the bill has to be paid. And you're beginning to see that there are very few outs. It's either succumb to inflation or let the system blow up, continue to print and give in to inflation, or let the system blow up. And that's what you're seeing in all these Western systems, that we're teetering. And I don't know, it just goes to show how fragile the whole ecosystem really is.
We're moving towards a gold-based monetary system, despite widespread skepticism among economists. Analysts predict that gold might rise again towards $2,500 if economic uncertainties, inflation, and geopolitical tensions continue. Historically, the U.S. thrived under the gold standard, experiencing low inflation and strong economic growth for 180 years until the 1970s. Today, central banks, including those in China, India, and Russia, are buying gold at record levels due to doubts about the dollar's long-term value, reflecting concerns about the U.S.'s global standing. Advocates like Judy Shelton, a possible future Federal Reserve head, support a return to the gold standard. Experiments with gold-backed bonds, like those in India, suggest growing interest in this system, signaling a potential shift in global finance. They're advocating for a gold standard and gold bonds to restore confidence in financial systems that have lost it. Some suggest revaluing gold rather than issuing a trillion-dollar coin. Platinum, though less prominent than gold in monetary history, is seen as undervalued. Its limited supply since 2008 and current price make it an attractive investment with potential to rise in value, particularly when compared to gold. As of August 2024, the price of gold is trading at approximately $2,326.43 per ounce, while the price of platinum has started to weaken, currently hovering around the $880 mark.
The author says, it's hard to believe, but we're lurching towards a gold-based monetary system. This despite the fact that the historical gold standard is held in almost universal contempt by economists and financial officials. Contrary to numerous myths based on ignorance, the system worked. The U.S. was on a gold-based system for 180 years until the early 1970s. We never had inflation when the dollar's value was tied to the yellow metal, and the U.S. experienced the greatest long-term economic growth in human history. The signs of change are here. One is that the central banks in recent years have been purchasing gold at record levels. Buyers include China, India, and Russia, and a number of other nations, such as Poland. Adam Lipinski. These countries are reacting to growing doubts about the long-term value of the dollar, which in turn is a symptom of the perceived decline of the United States. And I want you to think of Judy Shelton right here, who would be, I think, the head of the Federal Reserve if Trump wins. She's a gold bug. She advocates for the gold standard and issuing 30-year treasuries backed or redeemable in gold. It says India last year began experimenting with gold-based government bonds. Monetary expert Nathan Lewis, who co-authored our book, Inflation, What It Is, Why It Is Bad, and How to Fix It, observes, these would probably be very popular with investors worldwide. From the start of the floating currency era in 1971 to the present, a gold bond paying 4% would have outperformed every stock and bond market worldwide. Zimbabwe, which must hold the record for hyperinflation, recently announced the launch of a new fixed currency in gold. Deep skepticism is warranted that this government has the discipline to make such an arrangement work, but the move is a sign of things to come. So, in essence, what they're advocating here for is a gold standard, gold bonds, and tying a system to a tether that installs confidence in a country and in a financial system that's lost confidence. And through a Freedom of Information Act, I just read that actually was floated. Who knows if they actually do it, which would be kind of stupid. I'd rather see them revalue gold first than just jack up a coin and say it's worth $1 trillion. You got the 1 ounce platinum maple leaf at 80 over. Platinum's been really hard to get since 2008. The mints don't make very much of it. And you could argue that it might be as good of a value or even a better value, at least on many metrics, than gold. But it doesn't have the monetary history that gold does. And that's why the central banks are buying it. But its price is distorted from where it should be in relationship to gold and where it's always been with gold. So I think platinum will have its day too. And if you don't own any, it's not bad to have a little bit of exposure to it. At $80 over on the maples, it's as good as I've seen that in a long time too.
The increasing focus on gold as a cornerstone of financial stability reflects mounting concerns over the current economic landscape. With central banks bolstering their gold reserves and experts advocating for a return to gold-backed systems, the financial world is reevaluating traditional approaches. As inflation and market instability persist, the debate over gold's role in securing economic confidence and stability is likely to intensify, pointing to a potential shift in global financial strategies. Share your thoughts on Andy's suggestions in the comments below. If you enjoyed this video, don't forget to hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. See you next time.